I'm Charlotte McLeod with the Investing News Network, and here today with me is Paul de Sousa, Senior Vice President and Investment Advisor at Sightline Wealth Management. Thank you so much for being here online with me once again.
Thank you, Charlotte. Good to see you again.
Yeah, great to have you back. And as usual, we're going to start out with a little bit of discussion on gold. We last spoke at the end of February, and you said gold could face some weakness this year, but for you, you would see that as a buying opportunity. Definitely in the months since then, we've seen gold at lower price levels. So I want to start by asking what you think is behind gold's activity this year, and perhaps whether you've seen your clients take advantage of these lower prices to buy.
Yeah, it's seen quite a bit of volatility, and I think wasn't too pleased with how it responded to the employment news last week. So fell sharply, and there was a flash crash in Asia where about 31,000 contracts were sold in the span of about 45 minutes. So the good news is it did rebound after that. And I think that's due to the Fed indicating that it may not taper as soon as it said it would, and also concerns on the Delta variant. So I still do see continued weakness going ahead. And so back to your first question, did clients take advantage of it? Most clients are actually at their allocation. So any additional weakness, they just continue to hold. But for those who don't have an allocation, or it's probably under allocated, definitely use the continued weakness to get to that desired position, anywhere from, 3 to 10% of the portfolio. And in my opinion, that should be in gold bullion and versus mining stocks. Mining stocks is a separate asset class. And so in terms of continued weakness, definitely it doesn't look good, actually. There's the death cross, the 50-day moving average cross down through the 200. And the uptrend since 2019 has been breached to the downside. So we need to see 1800 level successfully held, then the 1900 before we would get bullish on the upside. But this is a generational asset, so I'm completely not even fussed whatsoever with what's happening with the price, frankly. And for those who own it, understand that, and it's just simply a minor nuisance in the grand scheme of things. This is a long-term hold, and coincidentally, past weekend was the 50th anniversary of Nixon closing the gold window. So lots of discussion around that.
Yeah, so definitely we've been hearing that there may be continued weakness in the price in the short term. And I know that for you, from our previous discussions, gold is a long-term play. It's something that you should have in your portfolio if you want to have a balanced portfolio. So maybe if you could talk a little bit more about where we might see it going this year, and perhaps some of the factors that investors should watch, because I know that people do like to keep an eye on what's happening right now, even though we should be remembering the long term.
Yeah, as you know, the technicals look weak, and so I see continued weakness. And then if the Delta variant or a fifth variant appears, then I think the Fed tapering won't occur. And in fact, there could be some more liquidity as well. A lot of uncertainty. So again, back to the 1800 level, going back against that 2019 uptrend, and then 1900 would have to be reached before we would get any confidence. So just more of the same. Just if you don't own it, use the weakness. The hold, have volatility be your friend here. So if you're long term on the price of it, then you can actually hope for lower prices. So just continue adding if you don't have it, and hold on.
For sure, pretty straightforward. So for gold this year, we have seen people a little bit disappointed. In contrast, though, for cryptocurrencies like Bitcoin, there's been a lot of discussion, and this is something that came up the last time we talked. So I want to get your thoughts on Bitcoin right now. You've told us it's something that you shouldn't ignore, but you should also be careful when you're trying to enter that market. So I wanted to get your thoughts on if there are safer ways that people can try to get exposure if they want to do that.
Yeah, look, recently last year, there's been many firms who have introduced funds and ETFs that are backed by Bitcoin and other cryptocurrencies. So that's definitely a route if you don't want to go to an exchange and set up the wallet and deal with all that's required there. And again, I think the advice back then, it would be, a minimum of, or probably around 1% of your net worth, and hang on. It's an extremely volatile asset. I think it's still in its early stages, despite it, probably becoming more mainstream the last few years. But many of us have followed it since 2013, and price declines of anywhere to 50 to 80% are very common. So we're in the $45,000 range right now, US price. So reached 30,000 just 3-4 weeks ago. So this is the type of volatility that we can see. Personally, I'm looking at anywhere from 30 on the downside, maybe 28, 25, 22, probably the most. I hope it gets there personally, again, hoping for lower prices if you're long-term on this. And the only concern would be is when to sell. I think that to me would be the greatest question is when. We won't get out the top, but possibly averaging out along the way up.
Okay, yeah, definitely when to sell is always a key question for investors. Moving on to look at the overall market right now, one thing that's been a big theme over the past year and a half is the uncertainty that COVID-19 has brought to many aspects of the world. And one of those is, of course, the workplace. I know a trend that you've noticed is people choosing to retire early to get out of that uncertainty. So I want to ask if you can go into that in a little bit more detail. Tell me what you've been seeing there and what that could mean.
Yeah, I've seen actually 2 cases. I've seen, or maybe 3. I've seen individuals that are just fed up. They're nearing retirement, and they definitely have enough money to retire. And they thought, what's 2 or 3 years earlier? Let's enjoy life. I think a lot of people are now quite aware of their mortality, and so they're thinking, life is short, and so let's enjoy it while we're healthy. And some may not be in the best of health either. So it's quite a bit of different situations. So that's one case, and others are simply actually changing careers. So what they're doing currently doesn't really align with their passions and interests, and so they're actually taking less money, doing something they enjoy. And so we're working with them in terms of seeing, how their plan works out, or how their finances. And in most cases, it's fine. They're taking a job cut, or sort of income cut, but it all works out well. And the third case for others is the COVID-19 pandemic has actually affected them. So they can't retire when they thought they would. And so that means continuing working amongst the uncertainty. And some are lucky to be in a position or a sector which wasn't impacted by COVID and continued working, and others were quite impacted. So there's a lot of conversations, lots of different, everything's very individual. And so some very personalized advice has to be given there. And the main thing is just make sure that the asset allocation is correct. And including, a common theme here is have other asset classes, including some alternative investments, protect against a downturn, have a cash position, have an emergency fund, beware of the sequence of return risk. So these are common themes that continually come up in all the conversations. And so they're always at the forefront.
Right. And as everything you've explained to us just now illustrates, every person is different. Everybody has a different situation that you need to give custom advice for. Are there any general principles or things that you would want people to consider, though, before they start going down this route of retiring early or changing their career path right now?
Yeah, I think what's occurred this year is a focus away from investing. I wouldn't say complete change away from it, but definitely towards planning. And we used to have these conversations, nearing retirement, but many are now considering it now. And so many don't have a will, estate planning done. They don't have insurance. They don't have a plan. And so this COVID crisis has now heightened that importance. So there's a shift from investing to more retirement planning. And let's face it, retirement means you're going to be taking a 30-year vacation. And so, when you state it that way, it kind of changes everyone's perspective. And so focus on tax efficiency and preservation. And so lots of conversations on just being able to be okay with the investments, say not capturing 100% of the upside return, and in return keeping the assets preserved. So a lower drawdown, and at the sacrifice of maybe not as much gains on the upside. So again, that all factors into the sequence of returns. We don't want to avoid large losses, especially nearing retirement.
Right. And that was definitely one of my questions that I have for you is how you help people who are retiring early maximize their returns when, of course, they won't be having an income anymore. So you've mentioned a couple of things. Is there anything else you would add there?
Yeah, so obviously gold as a generational asset, and that has to be bullion, and that's in portfolios. And then there's alternative asset classes, and those comprise mortgages, private debt, real estate, some hedge fund strategies. And so merger arbitrage, for instance, and even SPACs. I know SPACs have come off lately in terms of the popularity, but there's a particular strategy which is extremely conservative and yet produces some very respectable returns, all non-market related. So, to have, people kind of spend a lot of time in terms of asset allocation deciding between various equities and bond exposures, but at the end of the day, that's all market risk. And so really want to highlight that there's wonderful asset classes outside that. And so having quite a bit of discussions on getting exposure to that. And then the big question too, or the big theme too, is if everything in your portfolio is moving up at the same time, that turns into a portfolio where everything moves down at the same time potentially. So at all times, we really get ahead of it and say these may not perform at this time, but they will when others are not. So again, it's that constant reinforcement of having that balance.
Right. And, mentioning the market right now, one of the things that I keep hearing from the people I speak with is about the possibility of a correction in the market. So how are you dealing with people who may have that concern as something on the horizon?
Yeah, it's definitely looking at their investment allocation and then say increasing cash to withstand potentially 2 to 3 year bear market or correction, which may take 2 to 3 years to recover. And so again, you don't want to be withdrawing income while your assets are also declining. That's never a good idea. And so again, that comes with the potential that our timing's wrong in terms of the assets may, in hindsight, continue rising. And so we've taken some off the table, but I think I prefer that much than the alternative, which is the assets are falling and then we're pulling out from them. So, we don't have that crystal ball. All we can do is plan for today and then, know that running the analysis, that even doing that today still provides a wealth of income going forward, again, for that 30-year vacation.
Certainly. And I have one final question for you. I was going to ask you if you feel concerned about this trend about people retiring early. I was thinking maybe people are doing this and they're not ready. But from your comments, it seems like actually people are starting to think earlier about what to do. So what do you think about that? Is that a change we're seeing where people are, when they're younger, trying to prepare for what's coming next? And to me, that sounds like a good thing.
I think it always does. I think at the end of the day, people are now valuing more, I guess, their happiness, and is there a congruence in terms of who they are, what they're passionate about, and what they're doing. And unfortunately, some don't have that option or that ability where they continue in a role which they, it's not their favorite thing to do, but they, doing it because they need to. And others are fortunate that they can change careers. Or retire early and entertain all their passions and interests. So I welcome it. I think it took a global pandemic for everyone to realize this, that we're all mortal. We don't know when our time's going to come. So enjoy life. But at the same time, that comes with a healthy balance of, can't spend it all today, but set it up so that you have this income stream so that you can enjoy the next 30, 35 years, however long you plan to be retired, and still do everything you want to do. So it's challenging in terms of setting all that up. And I think one thing we have to be very cognizant of always is inflation. So always use probably a little bit higher inflation rate than what most plans account for. And it's amazing, if people use a 2%, throw in a 3.5, and see what that does to the income stream. It's quite profound. So again, plan for the worst and hope for the best, and everything should be all right in the end.
All right. Well, Paul, that's all I have for you today, unless you have any final thoughts that you would want to leave investors with for this moment in time.
Yeah, I think a few. It's I think Michael Lewis wrote in one of his books, I can't recall which now, in terms of investors always wait to see the whites of the eyes of a crisis before taking action. And it's just human nature. We always, we think it's out there, and then it occurs, and then we react. It's too late by then. And so gold is insurance, and even personal insurance, and taking care of your wills, power of attorneys, estate, all that planning. So you need to do that before you need it. Once things occur, it's too late. You can't do it after the fact. And so it's also human nature to take what happened recently in the past, very recently in the past, and project that into the future, assuming things just all continue. And that's not a foregone conclusion whatsoever. So, on one hand, the pandemic has taught us that things can happen very quickly and escalate. And so if there's anything on your to-do list or going through your head that you need to do, make a phone call your advisor, seek a professional, and check that off your to-do list.
Okay, that sounds like great advice to leave us with. Thank you again for coming on to talk. Always great to have you. And we'll look forward to having you on again in probably a few months to talk about what's going on.
Great. Thanks, Charlotte. Take care.
Thanks very much. And once again, I'm Charlotte McLeod with the Investing News Network, and this is Paul de Sousa with Sightline Wealth Management.